Welcome to the deep dive. Today we're really getting into the weeds with a major player in human capital management, Paychex.
That's right. We're looking at their latest 10K filing, the one for the fiscal year ending May 31st, 2025.
And our mission here isn't just about the numbers themselves. It's about understanding the whole machine.
Yeah.
The business, the financials, the strategy.
And maybe some of the surprising risks they face. These 10Ks, they look dense, but honestly, they're packed with insights people often miss.
Absolutely. So pulling out those key bits of information, that's the goal.
Right. It's not just the what, it's the why it matters for you, trying to get a handle on things quickly and accurately.
Okay, so let's start right there. Who is Paychex? What do they actually do?
Well, Paychex is basically an industry leader in HCM human capital management. They've been around a while, incorporated back in '79 in Delaware, headquartered up in Rochester, New York.
And HCM covers?
It covers a lot. Think HR, employee benefits, insurance, and payroll processing. They offer this whole suite of tech and advisory solutions, kind of a one-stop shop for managing the people side of business.
Okay. And they work with a lot of businesses, right?
Yeah.
The 10K mentioned 800,000 clients.
Yeah, roughly 800,000 clients and their employees. That's as of May 31st, 2025, mostly in the U.S., but also parts of Europe.
And that's up from the previous year.
It is, yeah. They were at about 745,000 before, so pretty significant growth, showing they're still very relevant.
So why is HCM such a big deal right now? What's driving this need?
Well, things are changing fast for employers. You've got way more regulations, federal, state, local, and they're getting more complex all the time.
Right.
Plus, the workforce itself is different, more remote work, mobile access. Employees expect a sort of consumer-grade experience with work apps now.
Like the apps you use every day on your phone.
Exactly. And then there's the constant challenge of finding and keeping good people. It's tough out there.
So Paychex steps in to help businesses handle all that complexity.
Precisely. They help clients adapt, taking on a lot of that compliance burden and operational stuff so businesses can focus on, well, their business.
Okay, so in this busy market, what makes Paychex stand out? What are they really highlighting?
They point to a few things. First, they're cloud-based HCM platforms. They've got Sure Payroll for their really small self-service businesses, Paychex Flex for small to medium, and then Paycor, which they acquired, for the larger, more complex organizations.
And it's not just tech, right? You mentioned advisory.
Right. They have deep expertise. Around 250 compliance experts, over 650 HR professionals on staff. It's tech combined with human support.
Makes sense.
They also focus on a modern, mobile, easy-to-use experience. Self-service options are big. And crucially, it's all scalable and customizable, delivered as SaaS software as a service.
Which means no big upfront software costs for the client.
Exactly. Lower total cost to ownership. And they're really pushing their data analytics and AI capabilities now using all the data they have.
Interesting. You hear AI everywhere. So it sounds like they're way beyond just cutting paychecks these days.
Oh, absolutely. Over half their revenue now comes from other solutions, not just basic payroll.
Like what? What else are they offering?
Well, things like talent management tools, performance reviews, compliance training, career development stuff, workforce management, optimizing labor costs, AI for forecasting labor needs, even real-time overtime alerts.
Clever.
They also have partner marketplaces like Paychex Flex Perks, integrating other apps, and they offer full outsourcing options like ASO and PEO, Administrative Services Organization, and Professional Employer Organization. Basically, ways for businesses to outsource even more of their HR functions. Plus, they're huge in retirement, the biggest 401k record keeper for small businesses in the U.S.
Wow.
And they even offer funding solutions like Paychex Advance or through Alterna Capital.
Okay, so pulling this together, what does this all mean for you, the listener, whether you own a business or you're an employee?
It means that these integrated, adaptable solutions are really becoming central to how businesses operate. Whether you're a tiny startup just trying to get payroll right and stay compliant, or a bigger company trying to manage talent and costs, services like these from Paychex are increasingly essential. They shape everything from how you get paid to how you access your benefits.
Okay, so we've unpacked the what they do. Now let's get into the financial side. How did all these services translate into performance in fiscal year 2025? Let's crunch some numbers from the 10K.
All right, so comparing fiscal 25 to 24, the top line looks good. Total revenue was up 6%, hitting about $5.6 billion.
Okay, $5.6 billion.
Adjusted operating income grew 7% to almost $2.4 billion. And
Yeah.
adjusted diluted earnings per share, or EPS, that was up 6% to $4.98.
And they increased dividends too.
Yeah, significantly, up 10% to nearly $1.45 billion paid out to stockholders.
Nice return for shareholders.
Oh.
Now, you mentioned adjusted figures. I noticed the reported net income was actually down slightly.
Good catch. Yeah, reported net income and diluted EPS were down 2%. But the adjusted figures, which strip out things like the costs related to the Paycor acquisition.
Oh, those one-time things?
Exactly. Those adjusted numbers show the core business grew nicely. It's a really important distinction. It tells you the underlying operations are healthy, even if a big acquisition temporarily skewed the main profit number.
Got it. That makes sense. So what specifically drove the revenue growth? Can we break that down?
Sure. Management Solutions, their biggest segment, was up 5% to $4.1 billion. That was driven by more HCM clients, getting more revenue per client, price increases and selling more products, and the Paycor acquisition helped too.
Right.
Even without Paycor, that segment was still up 3%.
Okay.
Then, PEO and Insurance Solutions grew 6% to $1.3 billion. That's mostly from having more employees covered under their PEO plans and higher insurance revenues.
And the interest income, you mentioned that earlier.
Right, interest on funds held for clients. That jumped 10% to $161.7 million. Remember, they hold client money for payroll taxes and such for a bit.
And invest it short term, the float.
Exactly. So higher average interest rates and bigger investment balances really helped there. Paycor added a bit too, but even without it, that income was up 7%.
Okay, revenue up. What about the other side of the ledger? Expenses. I saw mentions of both acquisition costs and cost optimization.
Right. Total expenses rose 8% to $3.4 billion. The main drivers were compensation costs up 2%, largely due to adding Paycor staff.
Mm-hmm.
PEO direct insurance costs went up 10%, linked to having more worksite employees. And other expenses climbed 9%, reflecting ongoing tech investments and, again, Paycor.
And the difference between those cost types.
Yeah, it's important. In fiscal 25, they had $162.3 million in acquisition-related costs. Think integration expenses for Paycor likely temporary.
Yeah.
That's different from the $39.5 million in cost optimization initiatives from fiscal 24, which is more about finding ongoing savings. They hit the bottom line differently.
Understood. So solid growth, managing costs.
Yeah.
How did this translate for investors? How did Paychex stock do compared to, say, the S&P 500 or its competitors?
Yeah. The 5-year stock performance graph in the 10K tells a pretty clear story. If you put $100 into Paychex stock back on May 31st, 2020,
Okay.
by May 31st, 2025, that $100 would have grown to about $250.
Wow.
Now compare that, the S&P 500. Your $100 would be around $205. And their peer group, similar companies or competitors, about $185.
So significantly better performance than the market and peers over that 5-year stretch.
Definitely. Assuming you reinvested the dividends, of course.
Yeah.
But yeah, strong outperformance.
Okay, so Paychex is clearly growing and performing well. Let's talk strategy. What's the big picture plan and how do acquisitions fit in?
Their stated mission is straightforward. Be the leading provider of HR, benefits, insurance, payroll. Essentially be an indispensable partner for businesses.
And the strategy to achieve that.
It's got several parts. Leading tech, obviously. Growing the client base. Getting more share of wallet, selling more services to the clients they already have. Driving innovation, especially in tech and AI. And, yes, strategic acquisitions.
Which brings us squarely to Paycor. That was the big one recently.
Absolutely. They bought Paycor HCM Inc. back on April 14, 2025. The price tag was roughly $4.1 billion.
And they financed that with debt?
Mostly, yeah. They issued about $4.2 billion in fixed-rate corporate bonds, a major financial move signaling how important this acquisition was to them.
So what was the thinking behind buying Paycor? They're a SaaS provider focused on small and medium businesses too, right? How does this fit, especially with the AI focus?
The key goal was really to boost their capabilities upmarket, serving larger, more complex clients than their traditional small business focus.
Ah, moving up the food chain a bit.
Kind of, yeah. It also significantly expanded their sales team, and critically, was meant to integrate and really enhance their AI-driven HCM solutions, so it directly feeds into that innovation and tech strategy.
Okay. And how did Paycor impact the books right away?
Well, in that short period from acquisition to the end of the fiscal year, May 31st, Paycor added $92.5 million in revenue.
Okay.
But it also contributed a net loss of $75.9 million for that same period. That includes those significant acquisition-related costs we talked about.
Right, the integration expense.
Exactly. And on the balance sheet, Paychex recorded over $2.5 billion in goodwill from the deal.
Goodwill.
Duh.
That's always a bit abstract. What does that represent?
Think of it as the premium paid over Paycor's tangible assets. It reflects the expected value from things like Paycor's brand, its existing customer base, expected synergies, and even its assembled workforce, basically, the value of having their skilled team already in place.
I see. And they also valued customer relationships separately.
Yes, that was the biggest chunk of the acquired intangible assets, valued at over $1.1 billion, with an estimated useful life of 12 years.
Was there anything else on the acquisition front? I think I remember something smaller.
Right, you're thinking of Alternate Capital Solutions. They acquired them back in July 2023.
What do they do?
They help small businesses with cash flow by buying their accounts receivable. It's called factoring. So it diversified Paychex funding solutions. Strategically interesting, but financially not nearly as impactful as Paycor.
Okay. So the theme continues. Invest in tech, invest in AI, acquire strategically.
Pretty much sums it up, both through big buys like Paycor and ongoing internal development.
All right. Now, no company operates in a vacuum. Every business faces risks. What are the big ones Paychex calls out in their 10K? What should you, the listener, be aware of?
Definitely. And it's always worth remembering these are potential risks outlined for disclosure, not predictions, but they group them logically. First, business and operational risks.
Okay.
A big one is just the pace of technology. The market demands constant upgrades, new features, integrating AI, machine learning. If they fall behind, it hurts quality, cost, competitiveness. Their systems could get outdated fast.
And bugs in the software.
That's another risk. Software defects, errors, development delays, these can damage client trust, cost money, lead to lawsuits.
And cybersecurity. That has to be huge, though.
Oh, it's massive. Cyber attacks and data security. They rely so much on IT networks, cloud platforms. The risks are severe breaches, intrusions, malware. And think about the data they hold.
Bank accounts, social security numbers, tax info, health info.
Exactly. Highly sensitive stuff. They're a prime target. And it's not just their own systems. A failure at a key third-party vendor is also a major risk.
So if something does go wrong,
That leads to risks like data loss and business interruption. A system failure or breach could halt operations, lose critical data, and cause huge problems for both Paychex and their clients.
then physical risks.
Disasters.
Yep. Catastrophe and business continuity. They need to protect their infrastructure from natural disasters, power outages, terrorism, even public health crises. They have plans, but you can never guarantee they'll work perfectly.
It's really striking how much revolves around tech and data security. That seems paramount.
It absolutely is.
Yeah.
Then you have financial risks. One is insufficient client funds. Remember, Paychex often pays things like payroll taxes on behalf of clients before collecting the money.
So if the client's account is empty?
Paychex could abandon the money. They say it's happened before. It's a credit risk, essentially.
Okay. What else on the financial side? That interest income on client funds the float is vulnerable. If government regulations change, say, requiring faster tax remittance or lower withholding.
Their float period shrinks, and so does the interest income.
Precisely. And finally, debt obligations. That $4.2 billion in new bonds for Paycor, plus existing debt, means they have covenants rules from the lenders they need to follow. Servicing all that debt could limit their flexibility or hurt their credit rating if things get tight financially.
Okay, so operational, tech, financial risks.
Right.
What about the wider world? Regulations, the economy?
Right. Legal, regulatory, and political risks.
No.
A lot of their services exist because of regulations, payroll tax, benefits administration. If those laws change significantly, it could reduce demand, cut revenue, or just make operations more expensive.
And simply keeping up with all the rules.
That's the non-compliance risk. The sheer complexity of laws in the U.S. and abroad, think data privacy like GDPR or CCPA, anti-money laundering, the Secure Act for retirement. Failure to comply could mean big fines and serious reputation damage. There's also intellectual property. Protecting your own IP, especially with AI evolving so fast, is tough. And there's uncertainty about who owns AI-generated stuff, which could lead to infringement claims.
And just general economic conditions.
Yeah, general risk factors like inflation, a recession, interest rate hikes. Those can definitely impact how much clients spend, whether new businesses form, affecting Paychex's growth. And, like any company, being able to attract and retain talented employees is crucial, especially in a competitive market.
Okay, wow. That's a lot to manage. Given how central cybersecurity is, let's circle back to that. How specifically does Paychex tackle those threats? What's their defense plan?
They detail a pretty robust approach. They state a strong commitment to confidentiality, integrity, availability, the CIA triad of security. Their program is aligned with the NIST Cybersecurity Framework, version 2.0.
NIST, National Institute of Standards and Technology. That's a recognized standard.
Right. They use a layered approach, multiple defenses, not just one wall. Continuous investment in security processes, risk management, detecting vulnerabilities and intrusions, and responding to incidents.
Did they have a dedicated team?
They do. They mentioned the Paychex Cyber Fusion Center. It operates 24/7/365, monitoring everything and handling incident response. Kind of like a security command center.
That sounds solid technically.
Yeah.
But you often hear the human element is the weak link. How do they address that? Training.
They do. Mandatory security awareness training for all employees when hired, and then annually. Plus, ongoing training and internal phishing tests trying to trick employees to see if they click bad links.
Smart. Keep people on their toes.
Yeah. And they also have a program specifically for managing risks from their third-party vendors. Risk assessments, contractual security requirements. They know a breach there could impact them directly.
So with all these controls and programs, who's overseeing it all? What's the governance structure look like?
It goes right up to the board level. The audit committee of the board oversees cybersecurity risks. They review the whole risk management process annually and get quarterly updates directly from the CISO, the Chief Information Security Officer.
Okay. And management's role?
Management implements the program, and that's overseen by an Internal Security Governance Council, the SGC. It's chaired by the CISO.
Who sits on that council?
It includes senior leaders from across the business operations, IT, finance, legal, HR, risk management. They meet quarterly to basically steer the whole enterprise security program. It ensures security isn't just an IT issue, but a business-wide responsibility.
That sounds like a good structure.
Yeah.
What about the CISO themselves? What kind of background do they have?
Pretty impressive, actually. The 10K notes over 2 decades of experience in information security, building programs for large organizations. They have relevant degrees, multiple security certifications, including the certified CISO.
And previous role.
Before joining Paychex in 2019, they were VP and CSO at another publicly traded HCM company and had leadership roles at banks, insurance firms, professional services, a broad range of relevant experience.
Yeah, like credentials.
Yeah. And the CSO reports to the VP of Platform and Technology Services, who also has over 20 years in tech leadership. As of the filing date, Paychex said they weren't aware of any material cyber threats that had actually harmed them, but they stressed they're continually investing in resilience.
Okay, that's reassuring. Let's connect this back to the overall financial management. How do they handle their money, investments, shareholder returns, especially given all that client cash flowing through?
Right. Well, on shareholder returns, they have that consistent dividend policy paid quarterly, usually August, November, February, May. But of course, future payouts depend on earnings and board approval.
And they have a lot of shareholders.
Over 7,500 holders of record as of June 30, 2025, plus all the employees in stock plans. They also have a stock repurchase program.
Buying back their own shares. Why do they do that?
The board authorized up to $400 million in buybacks starting January 2024, running until May 2027. The main reason stated is to manage dilution, basically, offsetting new shares issued, often for employee compensation, to keep the earnings per share from decreasing just due to more shares existing.
Okay, and liquidity, managing all that client money.
That's key. They manage a huge amount of funds held for clients. The average was almost $4.7 billion in fiscal 2025. They invest this float until it's due to be paid out.
What kind of investments? Anything risky?
No, they emphasize it's high-quality investment-grade stuff. Marketable securities, money markets, cash equivalents. They explicitly say no exposure to high-risk or non-liquid investment.
But they still had some unrealized losses.
They did. As of May 31st, 2025, about $53.6 million in net unrealized losses on their available-for-sale securities. That just means the market value is temporarily below their purchase price.
But they haven't sold them?
Right. They believe it's not due to credit problems with the investments themselves, and they plan to hold them until they recover value or mature. And that loss was way down from $162.5 million the year before, so the situation improved.
And interest rates, how sensitive are they?
Pretty sensitive, given the float. They estimate that a 0.25% change in short-term rates impacts their after-tax earnings by about $6.0 to $6.5 million over a year.
Wow, that adds up. Do they have backup credit lines?
Yes, they have unsecured credit facilities with major banks like JP Morgan and PNC, giving them access to about $2 billion if needed, mainly for any short-term client fund obligations, extra safety net.
So wrapping your head around all that,
Yeah.
what's the takeaway for you, the listener, about their financial stability?
Understanding these details really gives you insight into their stability and flexibility. You see how they manage huge sums of client money conservatively, how interest rates directly hit their bottom line, and how they maintain access to capital. It paints a picture of careful, prudent financial management, which is crucial for a company in their line of business.
And that really brings our deep dive to a close. I hope by digging into this 10K, which can seem intimidating, you now see how it really maps out a company's strategy, its strengths, where it's vulnerable.
Yeah, it really shows how everything connects: the business plan, the technology, managing risk, the financial health. It's all intertwined when you look closely.
So here's a final thought for you to consider. As companies like Paychex lean more heavily on AI, handle ever more data, and navigate constant changes in regulations and cyber threats, how will financial reporting itself need to change to keep up? How can it capture these complex, dynamic risks and opportunities clearly for everyday investors and curious minds like you?